Today, I want to take a look at the market trends for interest rates. And as we can see, the rates continue to rise. A normal question or a frequent question that we get is it a good time to buy? Now, I think a better question is it a good time to continue to be a tenant? So I'll let the numbers speak for themselves. The one of the one of the ideas or fundamental ideas that we have is that the time that you spend as an investor in the market is going to outweigh or outperform trying to time the market, right? So time in the market beats timing the market, and it's the same fundamentals for stocks. It's the same thing for for real estate and so forth. So what I want to take a look at today is as the rates continue to rise, should that affect your real estate strategy of creating a real estate portfolio going forward, or should you just continue to be a tenant and possibly maybe invest, some funds in the stock market or crypto or somewhat. Now, my in my opinion, the real estate investment is the cornerstone of every portfolio. There's really very few instances where it makes sense for someone that could buy a property for them to rent instead. I think that buying at the very least your primary residence is very important for building wealth. And remember, the goal is to build wealth over time. We're not really looking for cash flow per se at the beginning of or at starting our investing careers. We're building wealth over time, and we do that, or one of the best ways to do that is through real estate, accumulating assets, taking on real estate debt, creating rental properties, short-term rental properties. And then once we have our foundation established, then we can go into stocks, we can go into crypto. So what I want to take a look at today is the 10-year bond yield, right? We're continuing on an upward trend, and we continue to get the question of, is it a good time to buy or should I just continue to rent? And it's a good question to ask. It's not it's nothing crazy to ask that question. We're looking at a steady upward trend on the yield, and historically mortgage rates have mimicked or in parallel to the 10-year treasury. So mortgage rates have also risen over the past few months. We're looking back at beginning of January, end of December. I was calling for clients that were in the market to refinance or buy. Make sure you lock in your rates, refinance now before the rates go up. And suddenly the rates started going up, and many clients thought that they missed their opportunity. Now, if you are a tenant and you want to continue to be a tenant, I want to show you numbers wise why it makes sense for someone to create a real estate strategy where you're buying properties over time. If we find that, during our consultation that if you want to buy a property every 5 years, every 7 years, we set a goal to where you want to get to in terms of assets held. We can determine how many properties you need to buy, how often, and how much money you need to save over that time to get to that goal. So move this aside for a second. I created a very simple chart, Excel spreadsheet here, where starting at the age of 25, every 5 years, we're going to help you buy a property. And the rule is, or the anticipation is that every property you buy going forward is going to be $100,000 more than the one you bought before, right? And if we do this correctly, you're able to buy a primary residence every time you purchase with minimum down payments, which is just 5% down. So it doesn't require you to have to save 20, 30% to buy investment properties. You can create a strategy where you can buy these properties with minimum down payment over the course of time until you retire. So if you started out at the age of 25 and every 5 years you bought a property, you started out at 150,000, and from there on out, you only you only bought $100,000 more, never accounting for appreciation. So we're looking at, if you bought a property at 150, that by the time you retire at 65, the property is still worth 150. Now we know historically that's not the case. Real estate appreciates over time at about 3 to 4% annually. That's including the huge market crash of 2008. So historically, we know real estate prices will trend up. And but just for this exercise, assuming that they don't appreciate, assuming that you're only buying, that it's only valued at what you bought it for when you retire. If you set up this strategy where every 5 years you're buying one property, by the time you're 65, you're going to hold in assets $4.9 million in real estate. Now, the 5% down payment required, yeah, sure, it goes up over time, but you have to keep in mind, you don't always have to save this money. This money can come from adding home equity lines of credits to properties that have equity in them. So that way you can access the equity in your properties without having to sell them. You can do a cash out refinance and pull out the equity on your investment properties. So you can essentially use real estate debt to create a huge real estate portfolio without using your own money. If you like to create a strategy where you can liquidate or pay off most of these properties by a certain age, we could also do that. We can create a rental income strategy where if you need to get to X amount of money every month to pay down your mortgage, then this is where we need to be. We'll know what market to kind of point you to. We'll know how much down payment you need, and so forth. And right now, something that's yielding a lot of really, really good results is short-term rentals. So short-term rentals are yielding significantly more rental income than long-term rental properties are. Now, my opinion, you should not only have short-term rentals in your portfolio, you should have a mix of long-term and short-term rentals, just for risk factors, right? You want to not put all of your eggs in one basket. Just like I would probably advise against buying short-term rentals only in one city, for example. If some laws were to change in that city where now you no longer can rent properties short-term, you're essentially out of business. So I like to kind of spread out the risk. If we buy a short-term rental in Hollywood Beach, for example, the next one is going to be away from Hollywood. Maybe we can look somewhere in Fort Lauderdale, maybe in Dania Beach, something like that, right? But the point is, if we set a strategy where you're buying one property every 5 years, you can create a huge real estate portfolio for yourself and not have to create or save up 20%, or have to be required to give 25-30% for investment purchases. If we do it right, if we do it in the right order, we could do it all within the rules of the game, and you can create this portfolio. Now the question is it a good time to buy? Well, if you just set a strategy where you're buying every 5 years one property, it's going to significantly be much better to build wealth over time than it is if you just continue to be a tenant. If you continue to be a tenant trying to time the market or a market crash that may never come, or if a market correction comes, not a crash, just a correction, you now may tell yourself, well, the market is down, why buy now? And it's a never-ending cycle where you just never enter the market trying to time the market for, to hit that home run and buy at the absolute bottom. Where if you just kind of change your mindset a little bit, instead of trying to time the market to buy at its absolute lowest or its, the best absolute time, just stay in the plan to be in the market long period of time, long-term investment, build wealth over time. You also have to keep in mind that you get significant tax breaks for owning real estate. You get to write off a lot of expenses. You get to write off your interest paid to mortgages, your insurance costs, etc. So there's a lot of tax breaks that you get for buying real estate. So it's not only the building wealth factor that you have to consider. You also have to consider how much money, how much taxes you're going to save just by buying real estate. So there's a few ideas there. I hope you guys found this useful. If you want to just brainstorm some ideas in how to create or and how to create a real estate strategy to build a portfolio. Maybe you don't want to own 9, 10, 11 properties. Maybe you just want to own two or three that are very good cash flowing properties. We could also do that. The point is, don't continue to be a tenant if you don't have to. If you have money to invest in a sector like real estate that is relatively safe for a hedge against inflation, why not do so? Just create a strategy, build over time, and build wealth over time. Get those tax breaks, and stop being a tenant. Stop paying somebody else's retirement. So I hope you guys found this useful. If you have any questions, feel free to reach out to me. Otherwise, please hit the subscribe button and stay safe. Until next time, guys. See ya.